And, even in terms of multiples, it's trading at the lowest end of its last 1 year price to earnings multiple, or maybe just about 3 to 4% from the lowest point. So broadly, that's how we're set up, and which is why this one is interesting. Let me start off by giving you a sense of what the company is all about. And from an overview standpoint, this was incorporated in 1994. Market cap of around 2,850 crore right now. Integrated infra developer. It's a promoter-driven company, part of Ramky Group. In terms of verticals, it has the construction business, which is EPC, engineering, procurement, and construction of infra projects. And then there's a developer business, which is essentially a PPP business, which is public-private partnership, where they have assets, and those assets generate an annuity kind of a revenue of sorts. In terms of the product list, you'll see a very, very vast product list, but you'll see some parts of it in the water infra space. Water treatment plants, sewage treatment plants, common effluent plants. You've got tertiary treatment plants. You've got underground drainage systems, lake restoration projects. You've got waste-to-energy facilities, industrial parks, pharma parks. So now you've gone into proper construction, road, highway, expressway, bridges, flyovers, bus terminals, power transmission and distribution lines, electrical substations. So it's got a tilt towards power as well. Then there's residential and commercial buildings, institutional and healthcare buildings, mass housing projects is something that they do as well. You've got project management end to end, and you've got industrial park development, water transmission, smart metering, data center. You've got all of that clubbed into one, and you've got a 13,000 crore order book coming from Ramky Infra on a 2,000 crore top line, 2,100 crore at peak. So 6 times book to bill at peak, FY24, at peak execution. Let me talk about the states in which it has a presence. And again, interesting because some of these states are doing or have a tilt towards data center as well. So that's the other thing which is interesting. You've got Telangana, Andhra Pradesh, Uttarakhand, Jammu and Kashmir, Karnataka, Tamil Nadu as the key states in which Ramky operates. Let's talk now a little bit about the book to bill and the financials. The order book is around 13,000 crore. The book to bill is over 6 times, and now you'll get the financials in front of you. In terms of top line, the revenue, you've seen a 3% CAGR over the last 3 years. So execution really hasn't picked up. At the peak, FY24, revenue was at around 2,150 crore. It's fallen to 1,846 crore currently. We'll try and get a sense as to what's playing out on that count. But essentially, it's the execution, which is the question here. You've seen EBITDA. Now, EBITDA may not be the best metric, even though the numbers are on your screen, may not be the best metric simply because you've also got a component of other income, which is fairly large for Ramky Infra. And what you'll see, FY26 EBITDA at 230 crore, but PAT is larger than EBITDA because the other income number is extremely large. We'll try and get a perspective as to how that number also shapes up. But broadly, the 3-year EBITDA CAGR has been choppy in that sense, and therefore we've given this a thumbs down. When you're looking at PAT as well, profitability hasn't really picked up meaningfully, even though FY26 versus FY25 you've seen a pickup. FY24 was peak, and of course FY23 there was a very large one-time amount which came to other income, which has increased that FY23 number quite substantially in terms of profitability. Now, let's talk about the margins, and margins are expected to be in the 20 to 22% band broadly, but we've seen a margin cool off. Now, again, I'll try and understand whether, from management, whether this is actually inclusive of other income or exclusive. And we'll try and get a sense as to how should one look at margins as well. But currently, these margins are calculated, keeping out or removing any other income impact on the margin numbers. So for the moment, 12.5% is what it does in terms of margins FY26, and the choppiness doesn't add substantial comfort. Obviously, the 6-time plus book to bill at peak bill looks excellent. So from a traction perspective, they've got plenty of firepower in the order book to execute for a prolonged period of time. Now let's talk a little bit about the balance sheet. And the balance sheet, essentially, it's a 2,100 crore balance sheet, so nearly 1 time book to market cap to book broadly. And therefore, you've got market cap around 2,850 crore. So it trades at around 1.4 times book broadly, if you see it at the current juncture. Borrowing number is actually quite low. Short-term borrowings is predominantly what this borrowing number is about. And your cash bank balance is also fairly healthy. So essentially no concerns from a balance sheet standpoint whatsoever. We've given this a thumbs up. In fact, when you're looking at cash flow, this is again there's been plenty of choppiness in this number. And we'll try and get a perspective on that as well. FY 24-25 was good. FY 26, we've seen negative operating cash flow. Of course, in infra projects, you typically get that, but we'll try and understand from management as to when does this unwind, and will it unwind extremely sharply? Is this normal course of business? How does it play out? Also, what you're seeing on the return ratios is a fairly decent clip of return ratios, right? You've seen 16% plus in all years except FY 26. FY 26 has been 14% ROC, which is also not particularly bad for a company trading at 10 times earnings, right? And then you've got broadly a mid-teens to 20% plus at peak. So that's looking good from a return perspective, return ratio perspective. Shareholding pattern, you've got 70% promoter ownership at this point. So you've got a very decent promoter ownership. FIs hold around 2% odd currently, DIs own 1%, and public holds the balance, which is 27%. You look at valuations, it currently trades at 10.5 times earnings. The one-year average has been 17 times. And then you've got the one-year range between 10 and 22 times, or just below 10, 9.8 and 22 times. With a 6-year visibility, this is looking good, and some amount of annual recurring revenue as well. This is not looking particularly bad per se from a valuation perspective. But of course, there are risks, and we'll try and explore some of those with the management in just a minute or so. We're joined by Shravant Rayapuri, who's the CFO of Ramky Infra. Great having you here, Shravant. Let me first start off by understanding what's caused the drag in terms of growth and execution last couple of years, if you can give us some perspective. And is FY 27 that year where some of that unwinds?
Hi, good afternoon. So as we informed, as we interacted earlier, and we informed from a growth perspective year on year, it is 20-25% is what on the top line it is going to continue. And with the new orders in place, we are very much confident that this top line 20-25% increase we can expect, and the performance also in the similar way.
Caused the drag last couple of years, sir. Why has top line actually degrown despite your order book being very strong?
In terms of execution and in terms of the clearances from the respective authorities has slowed down, but the respective clearances in the current quarter the company has received, so it will progress as we mentioned.
Okay, understood. Talk to us about commodity costs and the pass-through of that. You have a large order book of 13,000 crore. Are commodity costs typically pass-through, which is generally how these contracts are worded? Is it the same for you as well?
Yes, it is the same for us, the company also. It is pass-through. The escalations have been taken care in terms of these projects.
Understood. And any labor challenges that you're facing? Because for some part of Q1, there were certain labor challenges which were getting faced by the industry as a whole. I'm not trying to pinpoint a number for Q1 because I know you're on silent period, but are any of those challenges something that you faced, and have you overcome them successfully now? Is that broadly the way one looks at it?
The challenges, yes, as you rightly said, we have faced it and we have mitigated that, and now currently we are in full on and also the company is progressing in terms of the labor issues.
Understood. Talk to us about this 13,000 crore order book. Can you give us the split broadly on how much is, say, power, how much is data center, how much is water infra, and how much is other infra? If you can just probably give us ballparks on some of those.
I can give you broad numbers with respect to the three verticals: industrial,
yes,
water and wastewater, and buildings. Industrial is 6,000, water and wastewater is 4,000, buildings is 3,000.
Understood. Okay, perfect. And are water margins materially better versus the other two?
So in terms of margins, it is with respect to industrials and water and wastewater, it is similar.
Okay, and that is in around the 18 to 22% number?
That's right.
Okay, so across the board, you typically do 18 to 22% in terms of margins. Is that the right way to think of it?
Correct. Considering the HAM model projects and also the payment timelines is across the 10 years period.
Okay, and give us a sense of what the bidding pipeline looks like. You're obviously extremely strong in terms of book to bill, and therefore lots of execution to go. But fresh bidding, how is competition evolving in this space? If you can give us a sense.
The bidding pipeline is also in the same verticals which we give priority on industrial and water and wastewater, which only in Q3 and Q4 will come up with the updates on this bid awards.
Of course. Give us your the confidence on this 20-25% execution number. For how many years can it go on for? Because and whether you can sustain that kind of clip for maybe 2, 3, 4 years, just given the fact that you've got a good visibility of orders in your pipeline, and therefore can you sustain it maybe 2, 3, 4 years from now as well? This 20-25% kind of growth clip.
See, the goal is the same. We will sustain, and with the current order book pipeline and also orders on hand, it will continue for 3-4 years.
Okay, so 20% growth maybe for 3 or 4 years will mean that you'll likely double on your top line from 2,000 crore odd to around 4,000 crore. Really, that will be the goal, right?
Correct.
And margins to sustain at 20 to 22 odd percent with that kind of top line.
Yes, yes.
Okay,
and we are
understood.
picking up the projects in a similar manner.
Understood. My understanding is that some of your peers actually do far lower margins and they're willing to pick up business at a lower margin. How is it that for typical infra-related projects, say road, bridges and the like, you're still able to confidently deliver 20% margin? How is it that you're able to do that?
The pick-off projects, what Ramky Infra does is in terms of industrial and in terms of water and wastewater, long-term projects, HAM model projects, and also lots of capital and also the technology and also the deliverance is put into the place. That's what makes the difference of getting 20-22%.
Okay, understood. And Mr. Rayapudi, very curious to understand how should one look at your P&L? Only from a perspective that you've got the chunky other income which comes in. I believe that comes from SPVs, right? And therefore, SPV contribution comes straight to other income. Talk to us about the trajectory of that number and the sustainability of that number, or will it be very choppy?
The other income is pertaining to more of accounting notional income with respect to Ind AS, and it continues considering the project life cycle and also the payment terms which with the SPVs company has agreed. It will continue 70-80 crores on a year. It will continue.
Sorry, sir, you said it's notional income.
Yeah.
So it's not on execution. It's on time more than execution.
That's right. That's right.
Okay, and is that how your P&L typically is also structured? Is it time based or is it, and therefore the mismatch on cash flow as well, right? Is that the right way to think of it?
That's right. That's right.
And therefore, when you execute a very large project, the cash flow will come in at the fag end. Is that the right way to think of it?
That's right.
Okay, and therefore no milestone based billings that you do?
We do milestone based billings here.
Okay, so then why does the cash flow come in a choppy fashion, sir?
So from a milestone based billing, if we do, and the cash flow is deferred after completion of the project.
Okay, so a larger chunk is at the end, which is
Correct.
why cash flow gets, okay. And cash flow from operations, sir, that has, FY26 was a tough year for CFO when I'm looking at that absolute number. Would you be concerned at all, and will that entirely unwind in FY27? Is that the right way to think of it?
So most of it is an unwind in Q1 FY26-27, 75% of it. The balance 25% in the current year it will unwind.
Okay. Could you repeat that? So out of the, say for example, you did EBITDA of around 250 crore last year, plus you had other income. So how much of the cash flow accrues, say, FY27, how much FY28?
Out of 350, 26, 27, 170 in 26, 27, and 27, 28, and the 150.
Understood. Okay, got it. Talk to us about the need for debt, because that has come off sharply for you. So what has happened that you've paid off such a large portion of the debt, and how does the debt on the balance sheet evolve going forward?
Going forward, the debt evolves on only with respect to the project-specific finance. On the standalone, it will be only non-fund based and little of fund based only.
And how much of your revenue is annuity versus projects which you are executing? Give us a sense of that.
20-25% of annuities, 75% is on regular income.
On the current top line, which is roughly 450 crore, is annuity.
That's right.
And does that go up?
With the current bidding projects pipeline and also the execution, it will slightly go up as per the revenue increase.
Understood. But it will remain 25-75 is what you're saying.
That's right.
Okay. And how should one think, therefore, of the IRRs on the annuity projects? Because that's the other thing. You're virtually... have you thought of hiving off some of the annuity projects into an InvIT REIT kind of a structure? Because that's typically what a lot of infra players are doing at this point.
Currently, we are not planning to do an InvIT structure with the SAM model projects.
Okay. And what is the kind of IRR you're getting on the annuity projects?
It will be close to 18 to 20.
18 to 20%, sir. That's the IRR? Wow, that's extremely strong. Okay, got it. Also trying to understand, therefore, debt doesn't go up substantially for you, right? In the near term, what's the CapEx pipeline looking like? How much?
CapEx pipeline is 500 to 600 crores.
Okay, that's in the current year, FY27?
In next 2-3 years.
In the next 2 to 3 years. And that should be taken care of by internal accruals, I would suppose, a large part.
That's right. That's right.
Okay. And any debt payments that you're planning to make? Because there's some short-term debt. I know it's at SPV level more than anything else. But is that cash flow linked, and therefore, whenever cash flows come into the SPVs, it gets taken care of, or how does it work?
It is cash flow linked. Whenever the SPV receivables are there, it will be paid off.
Okay. And what's your cost of debt right now?
Cost of debt is average 12%.
Is average 12%. Okay. And then you're doing an ROCE of 14. So therefore, your ROEs are far higher, closer to 20 is what I would suppose. Why wouldn't you take on more debt in your SPVs if there's an annuity cash flow model?
Correct that. We will be unlocking those SPVs receivables basing on the requirements.
Okay. Sorry, could you elaborate on that?
So basing on the equity requirements, we will be unlocking the receivables, free cash flows.
Okay. Okay, fine. Understood. With regard to how should one look at growth beyond the next 3 years? Say you're at 4,000 crore in terms of top line, right? Is 20 to 22% still a sustainable kind of margin number even beyond that in terms of top line once you've exhausted this 13,000 crore in terms of order book?
We will pause this question for now, considering LODR obligations at this.
Okay. Okay, understood. All right. The 70% holding by promoters, do you expect that to remain as is, or do you expect any changes there?
As is.
As is. Okay, understood. Thank you so much, sir, for coming in and speaking to us.
Thank you.
All right, viewers, all the time we have on this edition of All About Your Company, we got a decent look at what Ramky had in terms of commentary. Thank you so much for joining. Hope this was helpful.